little bugger, Tom Lee, has been awfully quiet since the Fed cut rates 50 basis points. And yes, I saved an image off Google to blow it up so you guys can see Tom Lee. But that's neither here or there. He's finally breaking his silence on this market. And technically, he did say one other thing recently, a short clip on CNBC, but it didn't tell us too much. And in fact, Tom Lee's actually been very quiet on his X account as well. It seems like he took a couple of days off, as he probably should have done a long time ago. But again, that's neither here or there. I'm going to play this clip of Tom Lee on CNBC. It's about 6 minutes long, and it's not exactly the stance that you would expect from Mr. Tom Lee. The clip here is actually titled, "What Stocks Do in the Next Month is a Coin Flip Due to the Election."
To our talk of the tape, how much more can stocks rise? Let's ask Tom Lee. He's FundStrat's head of research and CNBC contributor, live with us once again at Post 9. Nice to see you.
Great to see you, Scott.
You know, since the Fed did their jumbo cut, the market really hasn't done all that much except for one day last Thursday. Why?
Well, you know, I think the Fed unleashed us on an easing cycle, and that's going to be positive. We know it's actually historically positive 3 months, 6 months out. But what stocks do in the next month is a bit of a coin flip, and I think that's what we're seeing because there's some repositioning that took place. And also we're now thinking about the 40 days into the election.
So does the fact that the election is but 40 days away sort of ruin the perfect scenario for stocks to get that post-Fed bump?
I think it delays it, just because, you know, in the conferences that I've been speaking at and seeing wealth managers and family offices, a lot don't want to commit capital until after Election Day. And I don't think it matters who wins. It's just they want to get that event behind them.
Oh, so you think we're going to have sort of a dash to the finish after Election Day is out of the way?
Yeah, and that's pretty typical. You know, in fact, in election years, the November, December rallies are pretty tremendous. And in fact, when markets are up more than 10% in the first half, you also get big rallies November, December, sort of choppy through September.
You think investors are sold on the idea that this economy is going to make it? It's going to make it through. The Fed's going to pull this off. Is any of what we've witnessed since Fed Day doubts about the bigger picture?
So far, so good. This Friday, we get core PCE, and hopefully that confirms inflation is no longer on the front burner. But I'd say one thing I've noticed is that the number of investors and professional money managers that think we're already in a recession is very high. And so I think the evidence just has to be better than expected, and I think those views shift back to soft landing.
When we've seen, you know, recently targets for the S&P, Brian Belsky, I keep bringing him up because he's the most recent to raise his target up to the highest now on the street. I've asked you about, you know, the market lately. You haven't sounded like you'd be raising your own target to a degree like that, would you?
You know, I think there is a lot of upside in the foreseeable future. Let's say 3-6 months out. But for someone to tactically say we need to pin a 6,000 target and then put money to work today, I think it's harder to make that case because valuations aren't on the cheaper end, and we've already had a fairly sizable move. So I'm not saying I'm like bearish right now, but to me, I'd have a lot more confidence saying 3-6 months out, things are attractive, especially things like margin debt, right? It actually decreased in August, meaning investors have been deleveraging. Mm-hmm. It hasn't gone anywhere for the last 4 months at a time when markets are rising.
I guess my point would be, it would have been better articulated to just say, you don't sound as bullish as you usually are. Is that fair?
You know, yes, I'm bullish into year end, but I'm a little less confident about how markets behave into election day. And not that I think we're going to have a huge drawdown. If we do have a big drawdown, you know, I'd be buying that dip. But I also don't think we can make new highs and then see the market blast off after election day. So I'd rather sort of say things look a lot better after election day.
Can we make new highs if tech doesn't resume its leadership role in anywhere close to the degree that it had?
As long as tech is a market perform. If tech actually declines, that's going to be hard for the rest of the S&P 500 to compensate. But what we've seen so far, including days like NVIDIA and Tesla recently, is that tech is actually holding its own, but other stocks are starting to show catalysts and signs of life.
Yeah. What about the broadening trade? I mean, look, you look at the Russell, your big call, of course. Week to date's down more than 1%. Really hasn't done much at all. I kept hearing, hey, you got to wait till the Fed cuts. Then you go into the Russell. I don't know. What do you think?
Well, Russell had a big week last week. It's some profit taking now. But I think that there's, this is what bottoms look like. I don't think bottoms are straight up. I know in 2021, energy was bottoming, and it was also very choppy, but eventually made not only new highs, but then basically had a blistering gain in 2020, in the year following. So I think that's a multi-year start for the Russell. It feels choppy, but we're still near all-time highs, and there's a big fundamental case to own small caps.
Some have made the case that there are a lot of areas of the market that are overcrowded at this point. So many different sectors have gone up a bunch. You look at industrials and utilities and other things that have traded near or at highs. Therefore, they find better value in bonds. What do you think?
I think a bond investor is buying a bond for a different reason than buying an equity. Because an equity gives you not only inflation protection and benefit from falling yields, but also capital appreciation and positive surprise. Bonds rarely give you positive surprise. I think a bond investor someone should have some income with some capital upside there, but there are so many good opportunities. And, the fact that China has started to actually perform better and potentially broken out, that's again a Brent signal, because that's been a big drag for the last few years.
Oh, how about that? Do you feel like the move that happened in China this week's a game changer on how we should view what, the potential turn in their economy means for the overall markets? I mean, we've seen certain stocks get a nice boost, some of the luxury goods companies, right? LVMH, Estee Lauder, et cetera.
And the gaming stocks.
What about in the bigger picture?
It's hard to tell what's a trading rally versus a bottom for China. I spent some time talking to Mark Newton, our technical strategist. He thinks this is a bona fide breakout, and it is coming on the heels of not only stimulus, but in the face of unrelenting bad news for China. So to me, a rally on bad news is a sign that maybe the worst is already priced into China, and that means it could rally for a while.
All right.
Now, yes, I know what all of you guys are thinking. It's kind of unfortunate that Tom Lee did not talk more about the economy, but we already know Tom Lee's stance. He is in the soft landing category, because what I will point out at the start of that clip, Tom Lee said after Fed cutting cycles tend to be, positive returns for the S&P over the next 3 to 6 months. That is true as long as we don't have a recession, as long as the economy is actually doing better. Now, historically, don't shoot the messenger here, when unemployment is rising into Fed cuts, you typically get a bad market reaction. You typically get a weakening economy. You typically get a crash in markets. And you can see that here. If you are seeing the Fed cutting rates with a falling unemployment rate, you normally see the markets go higher. But ever since the late 80s, every time the Fed has cut rates, when unemployment has already started to move higher, it's been too late and you've had a recession. That's just history. That's just the historical precedent here. Don't shoot the messenger. People get mad here on this channel that I'm in the bearish camp, but I find it absolutely absurd that everyone is not in the bearish camp, or it's not flip-flopped. Like right now, you have 90%, 95% bulls, 5 to 10% bears. I think you should have that flip-flopped. You should have like 5 to 10% bulls, 95% bears. Based on what we've seen historically, everyone wants to use the bullish argument and say, this time's different because that happened then and this and that. And everyone wants to use historical precedents on the bullish side. But when you try to bring up the bearish precedents, which there's a lot more of them than bullish precedents, looking at history, of course, which this is one of them, it's hard to be bullish, especially when markets are pricing in such extreme growth, right? This would be a totally different story if the markets were pricing it in. The problem is not recession or soft landing or no landing. It has nothing to do with that. If you're an equity investor, what matters to you is looking at markets and saying, are they accurately or appropriately priced for the risk that we are going to see? Now, the risk could be downside risk, that the economy slows down. It could also be upside risk, that the economy accelerates, okay? There's risk on both sides. Risk is really just a way of saying miss an opportunity, okay? Now, right now, markets are priced for the upside. They're not factoring in any downside risk when all of these other factors, like every single data point we're getting nowadays is kind of recessionary, is showing that the economy is slowing down and there's no risk being priced in. Now, if this was a market that was down 20% already, I would not be nearly as bearish as I am today. In fact, I might be a bull. Now, is 20% downside enough? It depends how bad the economy gets, okay? I think 20% might be enough. 25% is getting closer to enough. 30%? If markets were down 30% from all-time highs, I would definitely be a bull. Because I think at that point, the risk is that there's an 80% chance of upside and a 20% chance the economy gets even worse, right? So it's all about the mismatch of pricing. Like Warren Buffett says, you will get insanely rich in markets if you invest your money over time. And as long as you're not investing at precisely the wrong time. Now, as equity market strategists like you and I, we're trying to figure out what's going to happen next. We're investing our money. Again, same logic applies. As long as you're not putting all of your money in at one price and going all in at one level on markets, you're going to do fine over time if you're putting your money in over an extended period in time. But there are some moments where we can sit and say, does this make sense? Are markets accurately priced? Should we wait for a better buying opportunity? That is this moment that we are in now. It doesn't happen all the time because markets tend to be pretty efficient. Now they're being a little, I don't want to say too efficient because they're really not efficient at all, but they're being too optimistic. Whereas like Warren Buffett, he would probably resonate with a lot of what I'm saying in this video because he just sold 30% of his portfolio in the last quarter. He clearly does not think now is the best time to be investing fresh capital. And again, does this mean sell everything? Absolutely not. Now, just to go back to what Tom Lee said as well in that clip, I kind of disagree with him a little bit around after the election. Now, normally after an election, there is a pretty aggressive rally, okay? Not always. 2008, there was not an aggressive rally because we were slipping into a recession, right? Because we were, well, already in a recession at that time, about a year in. There wasn't this aggressive year-end rally. So it really depends what's happening in the economy. Now, I think in the very near term, until maybe mid-October, stocks can probably do just fine. As long as the data does not come in really bad tomorrow, or the data that we get on Friday doesn't come in really bad, markets might be able to do okay from now until mid-October. I do expect maybe a 5% pullback around the election. Kamala Harris raising the corporate tax rate is expected to have a 5% haircut to EPS next year, so like that would make sense to me. Trump's tariff policies, we don't know what kind of effect that'll have, but maybe something similar, right? So 5-7% downside. Markets usually overshoot on the downside. They've tended to overshoot on the upside these days as well. That would make sense to me. But whether or not we see a great end of the year rally, I think is a little bit deeper than just normally that's what happens. It really just depends on what the economy is doing. And I also agree with Tom Lee's stance, though. If we don't get this election correction, if we just stay at all-time highs heading into the election, it is also hard for me to see, even in the most optimistic scenario, that stocks just rally, another 5 or 10% after the election itself, if you don't get any downside. So I think it makes sense that Tom Lee is a little bit less bullish here in the near term and a little bit more bullish in the longer term, the next couple of months, by the end of this year. Again, because Tom Lee thinks that the economy is going to do just fine, that we're going to get a soft landing, and that's of his view. So with his view in mind, it makes sense why the end of the year would be a really good period for markets. And if that's what happens, we will get a really strong end of the year rally. But at the same time, my view is you could start to see more weakness in the labor market, specifically in November and December and January, February, March of 2025. And these 5 months are really the period that I want to be on the lookout, potentially looking for some hedges. Do I think you need to hedge right now? Not really. Okay. Unless we get some really bad data tomorrow that all of a sudden spooks markets, I think it's an after the election kind of issue as far as where do markets go next. Do we fall 25%? Do we rise 5%, 10%? And that's another issue. We're talking about a market that could fall 20, 25, 30+%, whereas the upside is maybe 5 at like a moonshot 10-15%. Like if markets get 10-15% upside from here, that would be craziness. Okay, that would be like ridiculous with valuations where they are now. 5% would put the S&P at about 600 on the SPY, or about 6,000. 10% would put the S&P at about 630. Like that just seems very unreasonable to expect 10% upside. 5% is still extreme, but more theoretically possible. So let me know what you think about this information down below in the comment section. Let me know what you think about Tom Lee. Doesn't sound like his typical bullish self. And maybe there's some reasons for that. We'll see what happens. He did seem pretty clear in this video. He's not super bullish on the very near term in markets, but after the election, he's a little bit more bullish. But I think if you really sat down with Tom Lee, he would say, well, if the economy weakens, you're going to have a bad rest of the year. And unfortunately, we didn't get that clarity out of Tom Lee, his perspective on the economy, given some of the new data we have gotten. But I can't think that he's more confident in a soft landing based on some of the data that we've seen. So maybe that was some of the more downbeat attitude that we did get from Mr. Tom Lee. So with that said, guys, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.